The Indian markets have not just grown, they've broken several records in the last 25 years.
India's contribution to incremental global...
Welcome back to this special CNBC-TV18 Market Town Hall. We are in conversation with Chris Wood of Jefferies. We also have Ramesh Damani and Utpal Sheth, market veterans, Dalal Street market veterans here on the stage now with us. Thank you all once again. And of course, we've got a wonderful audience here. Once again, I'd like to thank all of you for being here and being part of this. Utpal bhai, if you can sort of, I'm just here to facilitate the conversation. I think it was flowing beautifully. So I'd urge you to share your perspective.
Thank you, Prashant, and welcome, Chris.
Thank you.
The 401k parallel that you drew, I think was very fascinating, and that was the driver of a structural and secular bull run in the US. It will be great if you could share with us what percentage of the pension funds eventually have exposure to US equities, and given that in India we've barely reached about 12% or so right now.
So 12%
of the pension funds
assets in equities.
Of assets are in equities.
Oh, well, they could go to 50%. That wouldn't be outlandish. So we're just in the very beginnings. This is just extremely the very early days. And obviously, you just need the tax incentives to encourage people to invest in equities, but my understanding, they exist. So to me, we're right at the beginning.
And a lot of it, of course, will also depend on how the economy itself does, right? And people have, as the country gets prosperous, and that's what happened with the US as well. Because, I mean, one could make the argument that those who can invest in equities and those who have the disposable income are already here. And now the country's got to get richer for more and more of the population to get into equities. I mean, would you? Yeah,
but but from my understanding, these pension schemes are recently conceived, right? With the tax incentives.
The NPS.
Yes.
Relatively newer company.
So to me, if it was like the test match analogy, you're at the first morning session. It's really very early days. So obviously in the long run, you're right, that's an issue, but I wouldn't, that's not that to me, we're right at the beginning of this whole development.
How much of, just to take off...
But you also have a history, you have a tradition of a stock market here. You see in China, you didn't have that tradition. You didn't have the legal infrastructure for a stock market. So India's had a long tradition of a capital market, so that helps it as well.
Got it. Ramesh Damani here, as I was saying earlier, was one of the early backers of public sector stocks, defense stocks. And those have been the clear leaders of the bull market. Rameshji, I just want you to share your latest thoughts and perspectives on it. I mean, Chris earlier was saying that he would bet tactically on consumption, but the big story still remains infrastructure. And a lot of it is sort of conducted through public sector enterprises. So just your thoughts.
Yeah, Prashant, Chris, I mean, what I've noticed over various bull markets, I've been in India for 30 years, is that bull markets always have leadership. In 90s in India, the cement stocks led, 2000, the tech stocks led. This time it is the public sector stocks leading, which was the most unloved, unknown, under-owned sector, which of course is a prerequisite for it to become market leadership. And a lot of people are left out feeling because they didn't enter it, and they're saying, first it was, oh, I'm not going to buy PSU at any point, no matter how cheap it is. Now they're saying, oh, it's too expensive, that's why I don't want to buy it. But the fact is the stock's about up 20x, 30x in between that time. So I believe that this leadership will continue because of better corporate governance, more government expenditure. And eventually all bull markets end, and so will the bull market in public sector stocks, I'm sure. But till then, I think there's a party going on. What do you think?
No, I agree. Now, the defense sector I first heard about 3 years ago, but in terms of my portfolio, I've missed the defense stocks. But the problem in India is what not to own.
Right.
So my portfolio has been basically built on where the performance of my greed and fear portfolios come from the last year, I would say, in property, energy, and infrastructure. But the missing part of my portfolio is defense. So let's say there's a sudden resolution of this conflict. Maybe the defense stocks will correct, and that will be an opportunity to add.
Please rectify that for us.
Yeah. And then another emerging area in which I'm not invested in, but I mean it's definitely getting more and more attention, is the contract manufacturing sector.
Right.
I believe you call it EMS.
Yes.
So this is an example of another emerging sector.
You talked about energy, Chris, though. Would you bet on the old fossil fuel energy, the oil, coal, because you think there's still a long way to go before energy transition? Or would you say, I'm going to avoid that and bet only on solar, renewable, etc.?
No, I've got the traditional energy sectors. To me,
They've actually performed well.
Yeah. So no, I believe that's a hedge. That's been a hedge. I've been telling investors, well, they got obviously crazily cheap when oil went negative, so there was an opportunity there. But also, frankly, if you want to hedge geopolitical risk in a global equity portfolio, your only practical way to hedge that is energy.
Energy.
And actually, even in an Indian portfolio, if you want to hedge the risk that oil suddenly goes up, because obviously this Middle East situation could... I've been primarily focused on Russia and Ukraine as a risk, but the Middle East is a potential risk. The only practical way to hedge that is energy, and these energy stocks pay good return, dividends. They're defensive, but they could be like tobacco stocks. Tobacco stocks the last 20 years have been good performers. So
Absolutely brilliant performance, surprisingly.
Yes, I would make the analogy with tobacco energy stocks. And also, the reality is fossil fuel is going to be around for a long time yet. Obviously, there's been an ESG constraint on some investors to own these stocks. But I'm not sure how big. I'm not sure ESG is not really big in India, right?
So, getting there.
Yeah, so ESG, in my view, peaked as a movement in the fourth quarter of 2021. There's always been a big belief in ESG in Europe. In the US, ESG only really started to exist in recent years, but it's now become part of the political divide. So for one side of the political factions in America, ESG is like a villain. The other side, they believe in it, so it's become politicized. And in Asia, ESG has never really taken off, as far as I can see.
It's there in every balance sheet as a disclosure of what they do for ESG. But Chris, I want to take up another point. You talked about inflation. Do you think the G7 will get inflation back down to the 2% rate that we enjoyed? And will it continue at 2%? What are the risks to that?
No, my base case has been that inflation in the US is likely to end up a bit higher than where it's been, maybe 3-4%. Because my base case is when push comes to shove, the Fed will prioritize the economy and the labor market over inflation. The surprise to me, though, I have to admit, is how resilient the US labor market has been. I would have thought we would have seen more clear weakness of the labor market by the start of this year. I think the Fed wanted to see labor market weakness because the Fed wanted to start cutting rates earlier, because I would have argued 2 or 3 months ago that the Fed wouldn't want to cut rates after July, because their concern would be that they would then be attacked by Donald Trump and be politicized. However, I've now changed my mind on that. I now think but as of data up till today, I think the base case is the Fed cuts rates in September after the Jackson Hole meeting. And I think the political constraint on the Fed's been removed, because the reality, even before someone tried to kill Donald Trump, the Biden health issue basically has meant that Donald Trump's in a very strong position, and all Donald Trump needs to do right now is to do something which is not naturally easy for him, and that is to stay quiet and be the unifying candidate, because so attacking the Fed would be crazy for him to do now. Right. And so basically, I think the Fed can cut rates in September based on data right now, and that's why you're seeing the US equity market, getting more risk on again.
Chris, sorry.
Go ahead, please.
Chris, if you could throw some light on the difference in the performance of the small caps versus the large caps in the US and the other way around in India.
Well, I would have to tell you, India is the only stock market I'm aware of right now where the small mid-cap sector is doing way better than big caps. Absolutely unique. And it's driven by this domestic phenomenon. This is not replicated in any other market right now. On the US stock market, the consensus view at the start of the year was that the US has achieved a soft landing and the US equity market would broaden out. The exact opposite's happened. So the US stock market's become narrower, which fundamentally is not healthy. However, it's not a speculative bubble, because I can show you a chart, and the Magnificent Seven earnings growth is just way superior to the broader market. So yeah, this
But in the last week, it's been broadening out.
Yeah.
The Dow and the S&P has been broadening
That's
out.
because the market now is getting more optimistic on a rate cut.
Rate cut, absolutely.
But obviously, if the rate cut reflects a weakening economy,
That's not good.
yes. So, but that's why it's broadening out. But the key point is Nvidia performance is so far fundamentally supported by phenomenal earnings and revenue growth on the part of Nvidia, which is obviously the star stock.
I think on a forward basis, it's still trading at whatever, 35, 40 times, right? And
Yes,
so
I actually started a Greed and Fair global equity portfolio recently, and I started at the worst possible time. I started it 2 days before the Microsoft purchase of GB Chat. Now, the irony is the most important development in world stock markets last year was nothing the Fed did. It was the Microsoft purchase of GB Chat, because that gave the biggest sector in the world's biggest stock market, the US tech sector, a new story. And I had about huge percentage, like 18% of my global portfolio in India, which is about 8. But luckily, I got positioned for the AI story during April after I talked to someone who explained to me in simple English why Nvidia is in this unique position.
I have two questions. One, will Fed cuts matter? I mean, they not hurt us when Fed was hiking interest rates. So will Fed, because we keep talking about, well, when will Fed cut rates? Will that matter in a significant way for markets?
Well, for emerging market asset class in general, it matters hugely, because the Fed cutting rates allows all these central banks in Asia to start cutting rates, because all the Asian central banks could cut rates, including the RBI, by the way, could cut rates for their own domestic demand reasons, because the inflation is lower than in the West, but they've been holding off because they don't want to undermine their currency. So I think for emerging markets, it matters a lot. I think it matters less for India, because India's in this amazing bull run anyway. But for many other emerging markets, it's very important.
Okay, I think, Nimish, you want to comment?
Well, it's been very interesting to hear all the three gentlemen there. But let me just walk up to N. Jay Kumar and ask him about what he feels on this current market. Jakes, thanks for joining us so early in the morning. I've heard you on many occasions that India is the oasis in the desert, given the fact that a lot of other global countries are struggling with growth and as well as inflation. But now is India becoming a consensus trade?
Well, a couple of points that I would like, your first day test match analogy. At one level, if you see the Indian markets, they've been performing as though there's no Middle East crisis. They've been performing as though there's no Ukraine crisis. There's no problem in any part of the world, because paradoxically, we've been getting oil at $20 cheaper because Russia is fighting over, Iran's fighting over with each other to try and supply us oil cheaper. So at one level, I think a lot of things have played out. So if you take the first day test match analogy, is there a threat of rain day 2, day 3, and therefore the chance of no result? That's one question, and I'll take off after you've...
No, the test match analogy is relating to the build-up of pension funds and the institute, yeah.
So the point really here is that every gentleman in the room here is bullish, the consensus bullishness, and is committed. Indian retail is buying on every dip. Globally, other than the foreigners, everybody else seems to believe that India is a place to go. So the melt-up, in a sense, we are in a process of a melt-up. Is there a risk that this consensus trade is actually that buy India is the global consensus trade right now?
Yeah, but the global money is not positioned in India. So I was talking about global emerging market funds being neutral. But there's a much bigger category of global investor who are global equity funds. They're not invested in India at all. For one very important technical reason, they haven't got, the funds don't have the FII registration. So they can't invest in India. So if maybe they have 1% of the funds in India, they have a very limited choice of what they could buy. It's the limited number of ADRs, which are basically, so they own a bank or an IT services company. They are barely positioned in India.
So the retail actually have got this right by being way ahead of the curve vis-a-vis global funds in some senses.
You see, because India is a practical constraint on foreigners being able to invest in India, actually, which doesn't exist in most other stock markets. You don't need to get, most countries are much easier to invest in for foreign institutional investors than India.
Thank you.
Chris, that's a very interesting point you raised. And if you could just expand on that, again, because we're in the policy environment, we're running into the budget. Over the years, a lot has been done to facilitate easier, compliance norms. Yes, there is a very stringent sort of rule of law, on knowing the last mile owner, the beneficial owners, etc. But what you're saying is foreign money is not coming into India because it's too difficult to come into
Yes,
India?
I'm saying the foreign money, the vast majority of the foreign money in India is global emerging market funds or regional funds. But the same foreign mutual fund company will have the FI authorization for the emerging market fund to invest in India, but they may not have it for the global fund. In fact, most of them don't have it for the global fund. So actually, many global funds own Chinese stocks, not just global emerging market funds, but the reason they own so many Chinese stocks is because so many Chinese companies were listed in ADR in New York. It was easy for them to own Chinese stocks. It's not easy to own Indian stocks. You have to go through the approval. You have to really want to do it. And then you have to go through you have to get all your internal approvals.
Yeah.
So I think right now a lot more global funds are looking at investing in India. This is just beginning. So my key point, any correction in India will be bought by foreign money.
Prashant, among all the market experts, we also have a very interesting guest sitting next to me, Saurabh Chawla, who's the Director of Finance at GMR Airports. The reason we called him is we all know that Chris has added GMR Airports to its model portfolio. But sir, I understand you're in the silent period, so you can't talk about your company. But in general, as a aviation player and as an infra player, what would be your expectations from this budget?
Well, I think everybody's talked about the equity markets. I would talk about the bond markets.
Yes, please.
Infrastructure needs very long-dated bonds. It requires very deep bond markets, and we don't see that happening. I mean, as a matter of fact, over the last few years, more retrograde steps have been taken to attract money into the credit markets and bond markets. I think that's where we would like to see the government deepen this particular capital market segment.
So in fact, we have a bond market expert in Utpal. Utpal, your take on his request on deepening the bond markets?
See, bond markets are essential to fund India's infrastructure growth. We need deeper bond markets, and I think the strategic intent of both the government and the regulators to deepen bond market is there. I think we need to reach a tipping point where it all comes together. But I can tell you that the corporate sector has been deleveraging over the last few years. We have one of the best credit environments possible. The banking system is very strong. The corporates are deleveraged. The credit discipline and consciousness is far greater. Underwriting is far better. We are ripe if all the right steps are taken, then we are ripe to take off on the debt side as well.
Well, Chris, it's been a pleasure reading your notes for the last 15 years or so, and it's an honor today actually to hear you in person. So thanks a lot for coming down. My question to you was on this, on taxes. A consensus from early this morning. I've been speaking to all the experts. No one's really factoring in that the government goes ahead and tinkers with the taxation on equities in this budget. But what if that is the case? What if two-part scenario? One is they only tinker with the short term, and the other one is they also go the whole hog and they tinker with the long term. You said it will have a substantial impact. You want to quantify it?
No, I think that will cause a correction. I think it will cause a bigger correction than what you saw after the election. But obviously, it depends on the magnitude.
Right.
But my sense from talking to, as you rightly say, my sense from talking to people in the last 2 days here since I arrived is they're not expecting anything. Whereas I got the sense before the election there was more of a concern.
But I think it'll be better if we expected something and then it didn't come, right? And not expected.
that was my worry, when,
yeah, I agree.
If they do a surprise. But maybe let's see at some point of this particular tenure of this government, if in fact they go ahead. But let's get Ravi Dharamshi as well in. Ravi, you have a few questions for Chris as well?
Yeah, sure. Thank you. I think last few years there have been a lot of contradictions. There have been a lot of breakage of correlations. So, I mean, as a local fund manager, we tend to keep an eye on the US market. What has baffled most of us is how did an interest rate rise from almost 0% to 5% did not result in a recession. And we have had bond yield inversion for almost 2 years now. Why has that not resulted in a recession? And a follow-up to that, one is if you can explain what is the reason why that did not happen. And second, will the cut in interest rate in September, if that was to happen, will that be construed negatively in the market since exactly opposite happened when the interest rate actually went up?
Right, no, it's a very valid point. It's been amazing how resilient the US economy is in this Fed tightening cycle. So maybe I'll make a few points. One key point to understand, which frankly I only really began to appreciate a year ago, is that the net interest payments of the US corporate sector in this Fed tightening cycle have gone down significantly. Net interest payments. Why is that? Two reasons. The big US tech companies have huge cash balances, so they're getting 5% where they were before getting nothing. Although those cash balances are now coming down because they're spending a lot on NVIDIA chips. Second point is the US corporate sector, investment-grade corporate sector, the CFOs did a very good job of terming out their debt, locking in bond yields. So more than 60% of investment-grade bonds do not mature until after 2029. So those, I think, are the key reasons why the corporate sector has been remarkably resilient in the face of Fed tightening. As for US households, subprime poor households are clearly, I think, already experiencing stress, but we need to remember they got big handouts during the pandemic, unlike here in India. So basically household budgets were buffered, had some buffer. It now looks like those what they call excess savings have now been spent. So that's why I think the US economy has become more vulnerable. But it's a two-tier economy because the baby boomers, the 65 and over cohort, are actually, their percentage of household spendings increased significantly. And they are benefiting from the equity bull market, but importantly, they're also now getting 5% on their money market funds, where before they got nothing. So that makes them feel much more comfortable.
Right.
So where actually, in my view, the area which actually is experiencing growing stresses from rising rates, but they're not really visible, is the area that boomed during the zero rate era. That's the private equity industry. That's where the stresses are building, but that's not. But the overall macroeconomy has been remarkably resilient.
You know, we were talking about risks, and but let's also talk about opportunity. Rameshji, PSUs has been the clear leader. Let me ask you this. You've said many times in earlier interactions, etc., in bull markets, don't chase the 20%, chase the 20x. 20 times.
Absolutely.
So where is the...
There's nothing more pathetic than making 20% or $20 on a trade.
And Chris is telling us that we've got a long way to go. I mean, there will be corrections, but it's a long way to go in the structural bull market.
But I wanted to you talked about opportunity, and what I wanted to ask Chris was something I've been grappling my head, and a lot of investors globally have been grappling their head. Is it too early to start worrying about AI impacting your portfolio? And how would you change your portfolio, alter your portfolio, looking at the advancement of AI? Would you get something out, put something new in? Could you just give us some of your insight?
No, but my global portfolio is a good example because I wasn't positioned for AI when I launched it. So what I've done with AI, I'm viewing AI as a picks and shovels play, to use a mining sector analogy, because NVIDIA is the ultimate picks and shovels play because everybody has to build their machine learning capacity. So I've just basically got in my portfolio what I call AI infrastructure plays. So so maybe it's going to be a 3-year CapEx cycle for everybody to build their AI capability. We're approaching 1.5 years so far. But at some point, we have to take a view on whether all this investment is going to lead to monetization. Frankly, I have no clue. I have no view on that.
Neither do we.
But at some point in early 2025, one's going to have to take a view. But it's not just. It's more than just building up AI infrastructure. Because when I was in Taiwan last November, which is the other big performing market this year in Asia, I first heard this term AI edge. So what is AI edge? AI edge is AI capabilities going on devices. Okay. And again, I have no idea if people are going to want to buy electronic devices like smartphones with AI capabilities, but I've got total conviction they're going to be built, which is why you also want to own the Taiwan supply chain. So if you look at a chart of NVIDIA and Taiwan's outperformance in Asia, it looks like Siamese twins. But at some point, we've got to take a view on whether it's going to become monetizable.
And the founders of NVIDIA are basically from Taiwan. So
They are.
that's the correlation. But I particularly want to ask you a very pointed question. Given what I've heard about AI and it will reduce the need for programming costs in India, would you think that programmers would be out of jobs in India in 5 years' time because of AI?
I think there's a real risk to programmers. Basically, it looks right now you'll be much better to learn to be a plumber than a programmer.
Really?
Well, we've got someone who's been
I-
tracking the IT
yeah,
sector for a long time here. What do you say?
So, Nilesh, I want to ask you, Chris spoke about looking at EMS as a space to further add into his portfolio. You've had a fair share of luck with the EMS companies. You've made a lot of money as well. Share your experiences on buying into EMS stocks, and are they now richly valued at this point in time?
Well, I think, Nimish, the big thing is that obviously as long as earnings keep going and if you see earnings growth of 30 to 40%, that doesn't become a reason for the bull market in them to stop. But I probably want to take Chris's views here. Chris, EMS has been a very, very big part of success stories of a lot of other economies at different points of time. Japan, South Korea, maybe China. Could you share some experiences you've had with that EMS space, how big that has become? Because that will be a big pointer in terms of where the EMS opportunity in India could really become.
Well, I think on India, I was already positive long-term in India without the manufacturing story. So to me, this whole China plus one development is just icing on the cake for the Indian macro story. So I think there's two key prerequisites for this story. One is you have these PLI policies set in place, which seems to be very sensibly constructed. So that policy exists, but you also, the other half, you do have this practical need for people to diversify out of China. Apple remains the best example. Because Apple virtually had all its production in China. I'm sure Apple probably wanted to keep it all in China, but as a practical matter, if you're running Apple, you have the risk that you wake up one day and the US Congress orders you out of China. So I think nothing, regardless of who wins the election, this China 1+1 capability remains in place. And also, I think the disruptive effect of Chinese competition on Indian manufacturers seems to have reduced dramatically. So that creates a long runway. But I've missed these stocks in my portfolio.
But I'm sure you will.
Like I've missed defense.
I'm sure you will correct that. I understand, Chris, you have a hard stop at 10. I'm being told it is 10. So we will try and wrap this up. It's a fantastic discussion, and I think all of us, would like to do this again. And we hope that we're able to get this gathering back again once we have the budget. And you were telling us earlier that you were going to come back after the budget. So,
maybe.
So we'll invite you here once again. But thank you very much. Enjoy the rest of your stay here in Mumbai, Chris. And thank you for dropping by here into our studios. Ramesh ji, Utpal, great to have you with us here and kind of sort of facilitate the conversation. Lots of learning, and thank you very much, all of you, for joining us. Sort of great to have you with us here as well on this special program. It's a wrap from all of us here. Thank you very much for being part of this special program. I hope it's a market holiday morning well spent. Thank you very much once again, and the programming continues here on CNBC-TV18.
India's basically I've taken the view